Hey guys, this is Rudy coming at you live from Florida in Palm Beach. I won't be smiling too much today, right? For the people who have been with the channel for a few years or so, you've heard me say in the past, on days like today, one Maserati, two Maserati, three Maserati. I'm not sure if there's a plural for Maserati in terms of how much you can wipe off your portfolio balance in one day, but maybe the plural is Maseratis. But I'll just go with one Maserati, two Maserati, three Maseratis. Anyway, what I thought I would take a little bit of time to do this evening. It is Wednesday. What is the date today? It is October the 4th. Is talk a little bit about the current news. Obviously, oil had a little flash crash today. And let's take a look at some of the news, especially from a macro point of view. And then I want to talk a little bit about oil futures, because that's really what we're discussing. So when they say WTI is currently, trading at $84 or whatever the case might be, you're talking about the futures contract price, which is actually the price for, in this particular instance, December. But let's just quickly, before I go into that, take a little bit of time and talk about the actual news that sort of happened today and all the stuff that's going on around us. So a couple of weeks, institutional traders have been buying crude and fuel futures, and then suddenly they became net sellers of both this week as they moved to take profits. Now, of course, you could say if there's a reason why they're suddenly taking profits, they might know something that we don't know. Otherwise, sometimes what they might be doing is taking profit as they go into Q4, because they would like to have some profits on the book and have a little bit of a cushion or a margin going into year end. Anyway, the sell-off by the institutional traders, and I'll just pause here for a second and just remind you that I've said this many times in the past. The largest oil companies on the planet are not necessarily companies like ExxonMobil and Chevron, and sometimes the largest oil companies on the planet are institutional traders like Goldman Sachs and Deutsche Bank and Morgan Stanley and so on, right? You've heard me say that before. So what I'm saying here now is that the speculators or the traders are basically driving the price. The sell-off by the institutional traders, don't confuse the institutional traders with institutional investors, right? So the institutional investors like Vanguard and BlackRock and State Street and that, they're not dumping any stock. These are speculators who are trading on the futures contracts. Saw WTI fall below $89. Obviously, this was earlier today, and we went much lower than that, and Brent trading below $91 with demand concerns helping to push prices lower. Despite the demand concerns, the decision by Saudi Arabia and Russia to maintain their product cuts and the refusal of U.S. shale to drill leave plenty. So like when you look at the news here, you have sort of contradictory statements, right? So on one hand, you can say demand concerns are helping to push prices lower, and on the other hand, you can say the Saudis and Russia are maintaining their cuts as it is, which leaves plenty of upside in the oil markets. So one of these is right, one of these is wrong, or otherwise maybe the answer lies somewhere in between. A couple of days ago, on October the 2nd, Reuters reported that oil prices fell about 2% on Monday. If you were long in oil on Monday, you would have obviously known that there was a decline. We took a little bit of a bath on Monday, only to go for a full-on long extended shower today in terms of rinsing all our profits away. On Monday, to a 3-week low as a higher priced Brent contract expired. So oil prices fell to about 2% on Monday as a higher priced Brent contract expired, right? We're going to talk about contracts in just a minute. I just want to give you the news first so that you can get the macro view of what's going on. The US dollar strengthened. This was also reported on Monday, and traders took profit, concerned about rising crude supplies and pressure on demand from high interest rates. Okay, so there's a whole bag of different things that happened there. A higher price Brent contract expired, the dollar strengthened, the US dollar, the traders took profit. And the reason why the traders took profits is because they were concerned about rising crude supplies and pressure on demand from high interest rates. On the first day, as the front month, Brent futures for December delivery settled at $1.49 or 1.6% lower at $90 a barrel, which is about 5% down from where it was the previous Friday. Higher interest rates and a stronger dollar makes oil more expensive for holders of other currencies. Might dent oil demand, right? So the higher interest rates and a stronger dollar is making it more expensive for holders of other currencies. But we have seen in the past few weeks, months, etc., how BRICS not only are trying to de-dollarize their economies, but in addition to that, they are attracting more and more people to their little party. The global outlook is quickly taking a turn for the worse. That is driving the dollar trade again and weighing on crude demand, says Ed Moya of Oanda. The manufacturing data shows us that the Eurozone is stuck in a downturn. Now, I have been saying we are in a recession based on the pure definition of a recession, and we have been in a recession for almost a year. Some people say we are heading into a recession, and I would counter that by saying we have already been in a recession for quite some time, even though it hasn't been too dramatic or too severe as of yet, unless you own commercial property, in which case the recession is very, very severe. China, which is the world's biggest importer of oil, according to the World Bank, they actually are maintaining China's growth at 5.1%, but they also note that there's a property sector weakness. And one of the reasons why they highlight that is because China's economy has become sort of slightly changed from being predominantly a manufacturing economy to becoming more and more like a property type of focused sector, where many of the Chinese people are investing in property as opposed to investing, for instance, in the stock market or business or whatever the case might be. The sell-off came as both Brent and WTI hovered at around $90 per barrel to the supply squeeze from OPEC and demand. On Monday, however, as funds continued to sell, WTI slipped below $90 to around $88 per barrel. That was on Monday. Now, of course, today we had about $84 at one time. WTI price slipped despite a close to critical situation with inventories at Cushing, Oklahoma, where there are less than 22 barrels as of the end of September. So just a few days ago, the inventory at Cushing, Oklahoma was down to less than 22 barrels. That prompts concern from many of the traders that that stock that's left over, in other words, that less than 22 million barrels from a few days ago will become unsaleable because of physical difficulties in pumping oil from near empty tanks. Now, if you think about that for a minute, that means that we actually have a supply crunch. And if the demand just remains what it is for now, it's going to tighten and it's going to be favorable, at least in the very, very short term. But we're going to talk about the futures in just a second. Demand for US crude and diesel remains high. I just mentioned that. Drillers in the shale patch predominantly have no intention of turning back into growth mode, regardless of wherever the prices are going, right? So in the shale patch, the drillers are not necessarily setting up rigs and drilling more. This is a quote. I just don't see producers getting all excited about near-term price, and I think we are going to see continued price volatility, said Rick Moncrief, who is the Devon Energy CEO. He added that oil prices could retreat in the next 6 to 12 months. We're going to talk about that in a little bit more detail in just a second, and that there was uncertainty about whether this retreat might be caused by a recession hitting oil demand. Now, there's that recession thing again and oil demand. And at the end of the day, what you have here is a variety of different vague type of statements because nobody knows for sure exactly where this thing is going. So let's just flick the switch here to something else and we talk a little bit about futures. I want to walk you through this because I actually want to show you that when you look at the futures from a macro point of view, you can reasonably and fairly accurately predict where this is going because the speculators and those investment banks are trading the futures. They are not trading the actual physical supply of oil. In fact, they might never meet the sellers or the buyers. They are simply trading futures contracts. So the current price of West Texas Intermediate crude today is $84.37 per barrel. This is actually live as of right now. So live chart is historical data, futures contract and breaking news on WTI prices can be found below. So right now, as of this is 8:30 p.m. on October the 4th, we have WTI futures for November 2023 at around $84.37. And you can see it's edging slightly green, right? So after a day of massive losses and a 7-day decline of 7.61%, we are now sort of going slightly green, perhaps going into tomorrow. In addition to that, year to date, it actually doesn't look too bad, almost 8%, and 1 year, 11.3%. So not bad at all. But now, a minute ago, I said you can predict with reasonable accuracy where this is going, right? So these are the futures. So I'm not looking at the live price on these little dots here. I'm looking at the futures. So the November 2023 futures are currently trading at around $84.38, which is the same as the live price that you can see over there. And then if we go 1 month deeper or beyond that, December 2023, it's 82.71, and so on, and so on, and so on. If we jump forward 1 year and we go to December 2024, we are down to $74. Now, speculators are trading these contracts today, which means if they wanted to do a margin call or buy long or short on these contracts, these are the prices that they're bidding in terms of the futures contract for WTI, which is specifically what I'm talking about. You'll see next to my little pretty face over here, it also says Brent, but I'm looking specifically at WTI. And you can see the decline all the way through. Now, of course, it's impossible for anyone to predict what's going to happen in the next 3 years. But if you do go forward 3 years from where we are today, you can see that the futures contract price for WTI for October 2026 is only $67.41. That is the trade price as of today. Now, before we go a little bit deeper into this, I just want to quickly show you some of the news headlines just here on my screen. Latest WTI crude news. The Permian oil boom isn't over just yet, right? So there's good times still to come. The other thing to keep in mind is that, remember, the larger producers, including some of the companies that you and I are invested in, have already told us that their break-even point is around $40 per barrel, more or less, for WTI, right? So even at a price of $67 3 years from now, they're still literally making money hand over fist as long as they draw enough in terms of keeping up with their current production. Now look at the sort of headlines here and see how they kind of conflict, right? So Goldman Sachs, this is October 4th, that's today. China's demand for oil and copper is booming. October the 4th, oil prices tumble as the EIA reports a significant gasoline build. October the 4th, why institutional traders selling oil and fuel futures? These are articles you can read. I mean, obviously, you could just Google oil price today and you'll get all this kind of stuff, right? 2 days ago, U.S. shale producers remain cautious despite the oil rally. 2 days ago, rising oil prices threaten economic stability. This is something to keep in mind as well, right? From a macro point of view, don't ignore the fact that the world's largest economy, the United States, is going into an election year in 2024. And there's a lot of noise around that election with Joe Biden. Who knows if he's going to run again or not? Donald Trump, who knows if he'll be able to run again or not, or anyone else for that matter. We know that there are people, including potentially independent candidates like Robert F. Kennedy Jr., who will be running for president and have already declared their candidacy. And of course, there are other contenders to the throne as well, but it's very volatile from a political macro point of view as well. But let's pause here for a minute and then I'm going to wrap it up. So what are oil futures? Oil futures are financial contracts that allow participants to buy or sell a specific quantity of oil at a predetermined price on a future date, right? So we're talking about November, December futures contract. And I showed you the futures contract all the way through to October of 2026 at $67 per barrel of oil. These contracts serve as an agreement between the buyer and the seller to facilitate the delivery of oil or the cash settlement of the contract at the expiration date. The specifics of the oil futures, and we're going to just touch on a couple of these because they might be interesting for you to either know, or maybe you know them already, but maybe it's just a refresher. The contract specifications. Each oil futures contract specifies the quantity of oil and the month in which the oil will be delivered to the buyer. Long and short positions, you're probably familiar with those by now. Traders can take either a long position when they're buying or a short position when they're selling in the futures market. Long positions profit from rising oil prices, while short positions profit from falling prices. Price speculation. The traders analyze various factors like supply and demand, geopolitical events, right, like war and de-dollarization and elections and such matters, right? Many times things that we have absolutely no control over, natural disasters, etc. And the economic indicators to predict the future of oil prices. Speculators who trade oil futures before the delivery date will not come into contact with either the seller or the oil, right? They're only trading the contract. They are not actually trading barrels of oil or buying them and delivering them somewhere. Margin requirements. To trade oil futures, participants must deposit an initial margin, which is a fraction of the contract's total value. That margin acts in a way as collateral to cover potential losses. Trading and settlement is probably self-explanatory, but while WTI contracts must be settled by physical delivery, Brent contracts can be settled financially due to technicalities in how the ICE Brent futures are set up. What is a front month contract? When you hear terms like the current price of oil or oil is trading at X today, these statements refer to the front month contract. The front month contract is the oil futures contract with an expiration date closest to the current date. In late May, the front month contract will be July, right? So there's always sort of a 2-month lag when they say the oil price today is $84. We're actually being October now, we are talking about the December contract. And then finally, just for your interest here, a rollover date are the dates where traders who wish to maintain their exposure to oil while avoiding the physical delivery of oil will close their positions in the expiring contract and simultaneously open positions in the next month's contract, or in the next contract month. This process is known as rolling over the futures contract. Now, I don't want to make light of anything that happened today because, I mean, it's a tough day on the market. And as I said right at the start, right, it's sort of one Maserati, two Maserati, depending on how much you have invested. At the end of the day, it doesn't matter whether you have $100 invested in the energy market or whether you have $100 million invested in the energy market. You know, 5% is 5%. And because it's a percentage, the losses are relatively equal. However, keep in mind that these losses are predominantly paper losses and don't necessarily impact you or affect you very much directly at all. Let me go back here to the internet for just a second and see if I can show you a little snapshot of our community channel on the internet. Well, I'm not going to be able to pull it up now, but I ran a poll on our community site here at Best Investor and asked the question, the YouTube question, what are you doing today with this flash crash? Are you selling or are you buying or are you doing nothing? The last time I looked, you know, there were several dozen votes and about 92% of the respondents said that they were doing nothing or buying more, right? So typically fear-based selling is a situation where you can actually end up losing a lot of money and it becomes a realized loss. So it's a difficult time to sit on your hands and do nothing because you watch your portfolio declining and it feels bad and it looks ugly. But doing nothing is a strategy. And if you wanted to nibble a little, you could do that sort of on the fringe. I wouldn't jump in boots and all right now because you don't know where it's going and you don't know what's going to happen next. If you have cash awaiting investment, you can deploy some of it. I wouldn't, once again, jump in boots and all and just start buying stuff because it looks like it's cheap. There are several of the stocks that we talk about frequently, like Occidental Petroleum and Devon Energy, etc., that are trading very, very attractively priced once again. And there's also an ETF like XLE, which is 40% Exxon and Chevron, and most of the other 60% are top tier, excellent companies like Phillips 66, Occidental Petroleum, Devon Energy, Valero, Marathon, etc. You buy XLE, put a little bit of money into that, but don't go nuts. Just focus on investing money in the first place that you are able and prepared to take losses on, as what happened today on paper, because you don't want to turn it into a realized loss necessarily, and also money that you don't necessarily need in the near term, right? So don't invest money into equities when you're going to need that money in 2 or 3 months or whatever to pay your bills or to do a home renovation or something like that, right? So just be smart at what you do and hang tight. This is not the end of the world. As I showed you, the futures are kind of edging slightly green. Maybe tomorrow it's an okay day. It's highly unlikely you're going to have a plus 5% day tomorrow, but maybe it's okay. So for now, on that note, this is Rudy saying thanks for watching. Take care, be safe, and remember, rule number 1 is don't take a loss, and rule number 2 is don't forget rule number 1. Goodbye.